we go. Okay. So this is called In Our Time. And I titled this at first because I thought that was happening with markets and the economy, and politics, and everything else in society. It seems to be accelerating towards that crescendo that I've been talking about for about 15 years, where we're going to see some very major changes. And it's no longer at some 10 or 15-year future date. I think it's in our time. I also like the name In Our Time because it's one of my favorite books, one of the first books published by Ernest Hemingway in 1930. It's really a compendium of short stories about the protagonist, Nick Adams, which I think is a stand-in for Hemingway himself. And it had tremendous acclaim. I have a copy of it here. I took a course on Hemingway in 1978, which is pretty remarkable, 43 years ago. And that's the book. And there's a chapter in it that I've always remembered, a very short preface to a chapter. And I'm going to read it now because I think it's just an incredible insight into the human experience. And it's talking about the Nick Adams, the protagonist at war in Italy in World War I. And he writes, while the bombardment was knocking the trench to pieces at Fossalta, he lay very flat and sweated and prayed, "Oh, Jesus Christ, get me out of here. Dear Jesus, please get me out. Please, 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 Christ. If you only keep me from getting killed, I'll do anything you say. I'll believe in you, and I'll tell everyone in the world you are the only one that matters. Please, please." The shelling then moved further up the line. We went to work on the trench, and in the morning, the sun came up, and the day was hot and muggy and cheerful and quiet. The next night, back at Mestre, he did not tell the girl he went upstairs with at the Villa Rosa about Jesus, and he never told anybody. So it's an interesting thing about the bargains that people make in the heat of battle and under stress, and oftentimes don't really live up to their promises. The picture here is also relates to the title. That's Neville Chamberlain, who was the Prime Minister of England, who negotiated with the Nazis in Germany. And this was him waving the piece of paper where Neville Chamberlain claimed that he had averted the war with Nazi Germany and he had achieved peace in our time, was what he said, holding up this ridiculous piece of paper. Obviously, that was a little bit like George W. Bush calling it mission accomplished back many years ago in the Gulf War. So what made me think about the Neville Chamberlain thing, in addition to the Hemingway, was that it seems that we have a lot of political problems going on geopolitically. And we're sort of declared peace in our time in Afghanistan, and that didn't work out so well. And hopefully we'll remain peaceful relative to the Ukraine and to Taiwan. But certainly the volume level has been heating up in those regards. So let me get started. I don't have as many slides as typically. I'm trying to focus on things that strike me as highly unusual in our world today, in our time. And I start with the granddaddy of all factors that's been driving particularly risk assets. The blue line on the screen, the light blue line is the S&P 500, and the dark blue line is the 10-year Treasury yield. And then we've got the gray line stepping up, which is quantitative easing. And we've shaded in green quantitative easing. It's 1, 2, 3, and now I guess it's 4 and 5. And you'll notice that, interestingly, against people's intuition, the 10-year Treasury yield, that dark line, goes up when they're doing quantitative easing. QE1, it went up almost nonstop. QE2, it went up early in the QE and then relaxed somewhat. QE3, it went up the whole time. And then here, COVID QE, lo and behold, rates rose. So now that the Fed is talking about tapering and now doubling down and maybe tapering at twice the pace and getting us out by March, weirdly, it would be more common for yields actually to be falling during that tapering and that sort of beginning. So you'll notice that the blue line is the stock market, and of course, it's accelerated very mightily thanks to quantitative easing periods. Obviously, aided and abetted by the Fed. Here's their balance sheet. We see that's been growing fairly constantly after that huge ramp up in response to the lockdown of the economy. We saw it resume at a very constant pace of about 120 billion per month. That's dropped by 15 billion in the upcoming month, and Jay Powell has stated that he's likely going to double that pace of tapering to 30 billion, which, as I said, would get us out in March. It's quite likely that since the stock market and risk assets broadly have been clearly supported now for over a decade by balance sheet expansion, is turning into a little bit rougher waters, I think, for markets as we move into tapering and ultimately raising interest rates. Most participants in the market now believe that Jay Powell has turned more hawkish and is likely to raise interest rates at some point in 2022. Some economists have now gone to a three hike regime. Now, what's been interesting is all the way since I took the Hemingway course just about at Dartmouth back in the late 70s, we've been seeing the economy cave in to stresses at ever lower interest rate levels of treasuries, and in particular the Fed funds rate. The last go round in 2018, the Fed funds rate couldn't even make it up really to 3%. And the stock market buckled and went into a bear market in the fourth quarter of 2018, which reversed very quickly as the Fed pivoted. And we went into an even bigger bear market, of course, in response to COVID. I think we're likely to see much more uncertainty and stress as the Fed has now decided to follow the bond market as they typically do, and they turn more hawkish. And Jay Powell will have a section on this in his presentation, has now admitted that transitory is kind of a meaningless phrase. He kind of mumbly mouthed it and said that for some unknown reason, people seem to think that using the word transitory meant short term, which I'm guilty of that. If everybody else is, I'm guilty of it too. I think that Jay Powell ended up trying to claim that transitory meant no long-term structural problem, but pretty clearly they thought that inflation would be elevated for 2 or 3 months, and it's already basically coming on a year and likely to stay elevated based on our work at least until the middle of next year. When I mean elevated, I mean a 4 handle at least on headline CPI. There is a risk that there's a 7 handle year over year CPI print. It could come in the next couple of months. If it's going to come at all, that might be it. But that would really be something to see. I think most people, at the beginning of 2021, if they were told that there would be a metaphysical certitude that we would see a 6 handle CPI at some point in 2021 year over year, I think very few people would have thought that long-term interest rates, the 30-year treasury I'm talking about, would be virtually unchanged on a year-to-date basis at this time. It's up about 15 basis points only year-to-date, and that's only thanks to a little bit of a rise today. It actually had a moment in recent days where it was only up a few basis points from the low, which was hit at the very end of last year. It's very strange how markets, particularly interest rate markets, tend to change direction right at year end. It's happened way more than should statistically happen during my career, where that the very first day of the year is either the high yield of the year or the low yield of the year. And that's happened again in 2021 for the 30-year treasury. The low yield of the year, at least so far, it's time's running out, but we're not very far above the low of the year, only by 15 basis points. But the low of the year was literally the very first minute of 2021. Now, obviously, the Fed's balance sheet going up has been stimulative. If you just look at real interest rates using nominal levels, real interest rate on the Fed funds is negative 614 basis points right now, thanks to the 6.2 CPI. When we say real Fed funds, we're just taking the nominal Fed funds rate, which is basically 0, and subtracting the CPI, which is around 6.2. So you get that negative real interest rate. You'll notice that the negative real interest rate is the highest, the most negative, I should say, at any time in history of this exhibit. And weirdly, it goes back to that Hemingway class that I took, where it was right there in about 1979 or 1980, where we saw the previous most negative real interest rate under Jimmy Carter. So we have lots of things that resemble the late 70s. Unfortunately, one of them is geopolitics, I think. And we also have these inflationary situation. This time we seem to like the inflationary situation better than we did in the 70s. Of course, that's somewhat sensible given all of the debt that's in the economy. The debt clock at debtclock.org has now surpassed $29 trillion. And the unfunded liabilities on the debt clock are back above $160 trillion, which is something like 650% of GDP. So we're going to have to deal with these problems in our time, and it seems like it's starting to accelerate into the moment of real change happening. Now, that quantitative easing that we saw in the previous slide, with the Fed's balance sheet going up to $9 trillion or so, that has been stimulative. And the Atlanta Fed, I've talked about this in the past, the Atlanta Fed has a study they've been doing for years that says, let's pretend that we didn't do quantitative easing. Let's pretend that the Fed just went negative on Fed funds. What would the Fed funds rate have to have been to create the amount of stimulus that is analyzed to have been created by the zero Fed funds plus the quantitative easing to this great extent? And the study by Wu and Shi at the Atlanta Fed says that it's about 180 basis points or so of incremental stimulus is the quantitative easing. So the real Fed funds shadow rate, which is the result of the Atlanta Fed's study, is nearly negative 800 basis points, far surpassing the negative interest rates of the Jimmy Carter era. So this has been stimulative, and with the quantitative easing being tapered, we're still stimulating, but it's less. So we're going to start seeing less stimulus to the economy, and rather quickly, if Jay Powell is going to continue to pursue a $30 billion tapering per month, we'll be back to about that negative 6% or so Fed funds rate that we saw without the shadow rate being involved. What's been one of the consequences of all of this? Well, of course, it's wildly stimulative economic growth. This is goods spending, and we take a look at what happened in the aftermath of the global financial crisis, and we saw a very steady growth in cumulative goods spending. It rose 48% from the nadir of spending back in early 2009 into the pre-pandemic. We saw a 48% increase. Interestingly, from the trough in the second quarter of 2020 into today, which is only about a year and a half, we have had goods spending go up by almost exactly the same amount as that entire 11 or 12-year period. We've gone up 46%. And I think it won't be very long that we surpass goods spending. So this has been tremendously drawn forward. If this chart reminds you of something else, maybe it's this that it reminds you of, which is the ownership, the dollar value of total U.S. equity ownership by U.S. households, which in 2009 was only $5 trillion, I think. And here it is at 6 times that level. And so this stimulus by the Fed with very negative interest rates and quantitative easing really retro-rocketed, obviously, the equity market. And that is turning into less of a tailwind at very, very high valuations. We'll be talking about relative valuations in just a minute. One thing that's interesting about all of this total U.S. equity ownership by households and all of this growth in the economy and goods spending is sentiment has not really held up very well in recent readings. This is the University of Michigan Consumer Sentiment Index, which was flying high pre-pandemic, up at 100, and it's actually starting to fall before the pandemic hit. We talked about how that was a recessionary signal in January, February, and March of 2020, and it didn't seem likely that a recession was coming, but weirdly, the sentiment kind of sussed out what was happening with the pandemic building, and we saw the recession actually hit. Look how narrow that shaded red bar is. Obviously, the so-called recession was short-circuited by all of this wild debt. As I pointed out in past webcasts, I don't have a lot of debt slides here today. I've used them plenty of times in the past. As I've talked about, the amount of government debt expansion has been more than the expansion of GDP since the trough of the COVID recession. So in other words, all of economic growth has essentially been debt-based, not just from the government, but also, I'm sure, refinancing of mortgages, which is actually healthy for people if they don't take out equity, but oftentimes they do. But it clearly reduces their propensity to default if they have a lower interest rate level. That's also true of the corporate economy. Much was made of the volume of corporate debt that was issued in 2020, but a great fraction of it was refinancing. So refinancing of higher interest debt into lower interest debt actually makes corporate balance sheets healthier. And so for all of the corporate debt that exists, we don't see a lot of defaults because the refinancing took over what might have been defaults with the effects of the lockdowns. And corporate America is actually in better shape than they've been in a very long time. But we see consumer sentiment is dipping down into levels that in the past have been associated with recession. It's not there yet, but it's falling pretty rapidly. And what's driving this drop in sentiment are two areas that have been so hot. And so it's sensible that consumers are a little bit more pessimistic about the forward-looking view. One of them on the screen now is autos. Ask the question, is this a good time to buy a car? And we have the lowest readings of all time. It's weird how this correlates to the negative interest rates. In our time, we're seeing things happen that haven't happened in 40 or 50 years. We've seen the negative interest rates I've talked about. We see auto sentiment is just as bad as it was back in 1980. This time it's not for the same reason. Around 1980, sentiment for autos was very low because interest rates were totally unaffordable, with short-term money at about 20% and mortgage rates up in the teens and so on. This time it's just that we had all of this money spraying by the federal government, creating outrageous demand, and also a shunning of public transportation with a contagious pandemic. And so auto prices just through the roof. And now we have the lowest readings ever. And this is a good time to buy a car. This is another thing that will probably be slowing down the economy as we enter into 2022, because autos are obviously a long-term purchase, and durable goods are by definition long-term purchases. They include autos, and this has been pulled forward. And so one could expect not only economic headwind based upon sentiment drags, but also from the fact that purchases have already been made. The same thing has been true for another category, which is red hot, which is housing. Is it a good time to buy a house on the University of Michigan sentiment? And it's not quite as bad as 1980 in this case, but it's in the same territory. So again, same as the Jimmy Carter era, and it's obviously because home prices have gone up so much. So again, in 1980, it was perceived to be a bad time to buy a house because interest rates were so unaffordable. Now interest rates are wickedly affordable, the most affordable of all time, because the inflation rate is well above the interest rate on a mortgage, particularly the inflation rate on housing. In fact, we'll get to that in a minute, but the inflation rate on housing is really off the charts and leads to our conclusion at DoubleLine that the CPI may stay elevated because the effects of owner's equivalent rent need to percolate through the CPI data in 2022. It does so with a lag. The methodology that the government uses, I don't think is very robust. I don't think it's very good, but it leads to a lag factor on housing inflation. So the inflation on autos may go away. The inflation on lumber may dissipate. The inflation on some of the supply chain bottlenecks may dissipate, but wage growth and shelter, as it's captured in the CPI, may replace it and keep inflation elevated. Our model at DoubleLine shows that looking out to the end of 2022, it's very possible that we don't see a reading that has a handle below 4 at any time in 2022, which makes interest rates at basically 1.5%-ish or less on treasuries look extraordinarily overvalued. So that's what's dragging down the economy and may lead to a drag on the economy further, with the Fed starting to get hawkish and consequently they're going to raise interest rates. I believe the pattern of the past 40 years of the economy buckling under ever lower interest rate hiking regimes, in other words, that the interest rate doesn't have to rise as much as it did years ago, I think that pattern is going to continue. So it's likely that we will see economic problems with just a few rate hikes from the Fed, maybe only 4 rate hikes or so. Maybe it's 1 or 1.5 on the Fed funds rate that breaks the economy. And as we see what's going on in the bond market, which is very negative yields and an ever flattening yield curve, which we'll get to in a moment, since March of this year, The bond market seems to be sniffing out a weaker economy coming, and the curve is flattening at a sufficient clip that one should expect economic problems sooner rather than later. My base case is we'll start to see trouble by the second half of 2022. Now, back to work is interesting. Another thing that's factoring into sentiment and the changes in our time is the way in which people work. Very many firms are going to a hybrid model of back to work. Here in Southern California, we have some of the more stringent policies, and we were going to have more of a back to work in January, and still might. But it depends, of course, on how this latest variant ends up developing. It's kind of fascinating how the back to work turnstiles in Manhattan. So this isn't for the country as a whole. This is for a major population center of Manhattan, and I feel like it's the same largely in other major population centers. This is the turnstile entries in Manhattan, and we can see that they're still down 60% from where they were pre-pandemic. So lots of changes coming in the way people work. Another manifestation of changes in workplace habits are the Great Resignation, as it's being called, where many job seekers have been surveyed as saying they want to switch careers, not just jobs, but careers. I saw a survey about a month ago, and if memory serves, it was 58% of those responding said they're seriously contemplating a change in their career. But this is the flip side now of the housing and the autos. This is a good time to buy a house and autos. No, is the survey result. Is now a good time to find a quality job? Well, we're off the charts. I don't know if this survey existed before 2002, but since that time, over the past 20 years or so, we've never seen people say this is a better time. There's been a better time to find a quality job. And one thing that I think captures that is the next slide. And here it is. This is the NFIB jobs hard to fill, which is the black line, the dark blue line, and it's overlaid against the small business compensation plans index. So not surprisingly, when openings are hard to fill, that's correlated with worker compensation plans being increased. And we see very high for index reading on worker compensation plans. And I don't think DoubleLine is alone at feeling like we need to pay our employees more because of the risk of the Great Resignation. Fortunately, at DoubleLine, we have very low turnover by investment industry standards, and we continue to. But I do think that people are having lifestyle shifts in our time as they deal with the different ways in which society has to organize itself, as this pandemic is now really 2 years old, at least 2 years old. I think the cases that were initially reported in China were more than 2 years ago now. Now, one thing that's interesting about this, with these worker compensation plans going up, this is a slide I've used before. I find it fascinating. It's really all low age workers. This is the Atlanta Fed wage growth tracker by age, and the lowest cohort is that purple line on top, and that's ages 16 to 24. So these are entry-level jobs, probably baristas and bartenders and waiters and people who work at fast food restaurants and the like. And we see that we have the highest wage growth in over 10 years, so 15 years really, on that cohort, and it's gone straight up since the pandemic. Interestingly, all the other cohorts, I think that one's mislabeled. It says age 22 to 54. I really think it's 25 to 54. But at any rate, the other cohorts that are older than 24 years old, there has not been much acceleration in wage growth. In fact, it continued to decline. It was growing, but at a gently declining rate post-pandemic. And just now, we're starting to see it go up. And we've been watching this carefully. Last time I used this slide, we did not see these upticks in the overall rate or the 22 and older crowd, and certainly not in the 55 and older crowd. And we're starting to see it. And I don't think this is a coincidence. I think the wage growth of the entry-level jobs is going to start pushing into wage growth at higher levels. I saw a sign at a Denny's, I think it was, where it said, now hiring, of course, all shifts, all locations, full-time, part-time. And it said entry-level, unskilled, $16 an hour. And below that on the sign, it said supervisory jobs, $16.50 an hour. And I almost had to drive off and park on the side of the road. I was so flabbergasted by this, that the gap could be so small. And it made me realize that probably that higher wage for the entry-level job would lead into higher wages as you move up the ladder. And I think that's happening here. And we're starting to see it even the 55 and older. So I do think that some of the goods inflation that was so prevalent here in 2021, that may ease. But I do think wage inflation is starting to increase. And I do think that for sure, shelter inflation, we'll get to that in a second. Just talk about equities for a moment. I'm really going to talk about the attractiveness on a valuation basis of emerging market equity. This slide shows the outrageous outperformance of the U.S. versus the rest of the world. So what we have here is the red line, which is the price of the S&P 500 divided by the MSCI World Index. And this goes back to 2006. Let's just look at the last 10 years, where it went from 0.8 to nearly 2. So more than a doubling of the performance, about 150% outperformance of the U.S. versus the rest of the world. And the one thing that's really underperformed is emerging markets. The blue line is the PE comparison. So it's the U.S. Compared to the rest of the world PE. And of course, the blue line being down means the U.S. is really expensive versus the rest of the world. Of course, it hasn't been this expensive, and it's gotten way more expensive in the past couple of years, thanks primarily, I think, to the very direct money giveaways in the United States, translating into tremendous profitability, although the PE has grown even more than just that profitability gap. So let's take a look at the emerging markets. And here we have the S&P 500 just divided by a subset of the rest of the world, the emerging markets. And look at the outperformance of the S&P 500 this year, basically, where we see that emerging markets have underperformed. It's got the index. The comparison here is the S&P divided by MSCI emerging markets, and we see that it's gone from below 7 to up to 9.5. Recently was the peak, and there hasn't been much of a correction along the way. So this is a very, very strong outperformance. S&P's up a lot and emerging markets are down a lot. There's about a 40-point difference. And some emerging markets, it's a 50-point difference. So S&P might be up 25 and the emerging market might be down 25. Some are even down 40. So that's clearly due to economic outcomes and the problems of healthcare systems and the pandemic problems in many of the emerging markets. So that has also been due somewhat to the dollar, which has strengthened particularly against emerging market currencies. Here's a comparison just using the Dixie index, which is the black line, and the Bloomberg US dollar index, which is virtually the same. That's the red line. And then we see US dollar divided by EM. And so we see just how that blue line is the US dollar outperforming emerging market currencies. And that's really accelerated very recently. Obviously, this just does not look like a top in that blue line. It looks like it has a lot of momentum and it may go further, but we're on watch for seeing the dollar reverse. I've been talking about how the dollar would likely be strong in the second half of 2021. I said that in every webcast this year and last year. We expected the dollar to have a good year in 2021, particularly in the second half, and that's happened. My long-term view remains strongly dollar bearish. So a lot of people don't listen quite carefully and specifically, and they hear me say that I'm long-term dollar bearish, and then they turn around and say, you've been wrong on the dollar. No, I haven't. I've been right. I've been spot on the dollar this year. I said it would be strong in the second half. I think we're looking at a weak dollar as we look forward to call it second half of next year, maybe 2023. But the dollar is going to go down thanks to the twin deficit problem in the United States. I've included that slide repeatedly in webcasts. I don't have it in this deck, but the dollar has made it 297 on the Dixie index, and it looks like it's starting to stall out. 97 was something of a target. You'll notice that black line, the Dixie index. We expected it would get up into that congestion zone of 2018 or 2019 rather, and start to run into resistance there. That appears to be starting. When the dollar starts to go down, you're going to see tremendous outperformance by non-U.S. stocks, kind of some of the reversal of the slides we saw in a few slides ago. Emerging markets will be a very strong performer when that happens. And now the European has started to underperform again. Here's just the long-term view of the Dixie index. We see that it had bottomed out on that horizontal line. We expected that would happen. We see that the rally that's happened, but notice the long-term trend of the dollar, which began really back in 1985 when the dollar was at its highest level. Ever since then, we've seen the dollar being in a broad declining mode for the past nearly 40 years. And we see declining highs and lower lows. We think that pattern will continue. In the near term, we've been bullish, but we think that when we break down below that horizontal line, we think it's going to start accelerating lower, and that would be the buy signal. So one doesn't have to be anticipatory and try to be a genius and try to pick the high tick. I think you let the market do the talking, because when the dollar starts to slip, I think it's going to slip pretty mightily and take out that low of 2009, which was down there at about 70.7 or so. So that would be quite a drop from here and lead to strong translation for dollar-based investors if they invest in foreign currencies. So that's a theme that we'll be developing, I'm sure, in the Just Market webcast as well. Here's S&P long-term versus emerging markets. And it's really fairly incredible. See, the last time we had valuation like this was really in the run-up of the dot-com situation. And it's very fascinating to see charts that compare the dot-com era to some of the speculative froth today, like some of these funds that invest in very go-go companies, basically had the same run-up as dot-coms did in the late 90s, and now have clearly rolled over and are showing the magnitude of decline the dot-coms had in the aftermath of the dot-com bust. So this emerging market thing versus the S&P looks kind of the same. We're not quite there at the peak, the double top of the 90s and early 00s, but we're in the same context. So on a valuation basis, I think it's early. Again, I wouldn't execute the trade today, but this is remarkable how much emerging markets have been able to outperform U.S. stocks when the time is right. Just look at how much the emerging market, it was a full round trip. All of the outperformance of the middle of the 90s was completely reversed over the ensuing, say, 6 or 8 years after the dot-com bust. That could very well happen again. I don't have the CAPE ratios in the deck this time, but the CAPE ratio of emerging markets is less than half of the CAPE ratio of the S&P 500. And it has, in the past, had times when it was higher than the S&P 500's CAPE ratio. So one could potentially anticipate more than 100% outperformance for emerging markets when the worm turns. We're not claiming that it's turned already, but it's the next big trade. And so we want to keep our eyes on it. This is also an interesting thing for the emerging market currency index. This is the JP Morgan emerging market currency index. And you'll just see how low it is. I haven't come down once again, and it's double bottoming here and may exhibit a throw over, which would be that gray horizontal area if we were actually go to a new low, which I think maybe we are right now, but then reject that new low and bounce back above. That's what we'd be waiting for an early warning sign that perhaps this trend is changing. But this has been a mighty underperformance. The trend is always your friend, but we're looking for major opportunities. And this could very well be one as we look forward 2 or 3 years as an investment horizon. Let's talk about inflation. Here's a global inflation surprise index. The constituents are various countries. You notice that they're all surprising to the upside. There isn't a single observation on this display that is below zero. So it's a global phenomenon. Here's the CPI contributors in the United States. It's interesting how the core services was negative for a while, and now it's joined on the upside, that yellow shaded area. We can see that energy is contributing. Just about everything's contributing except food, which feels to me like it's being underreported. It feels to me that food is contributing more to the CPI, but perhaps that's a methodology thing. I would say maybe food prices could be another engine that keeps the CPI from going anywhere close to where it was pre-pandemic. Remember when they couldn't get the CPI to get to 2%, and now I think they'd be happy They think it's low inflation now if it went to 3%. Also, it's fairly broad-based. Here's an exhibit I've never used before. This is the percent of the CPI basket, which is about 200 different items, with prices increases of greater than 4% year over year. And this goes back to 1990. And it's basically the highest reading. It's about 45%. So something like 90 out of 200 components are basically rising greater than 4%. And this sure looks like a powerful trend. So we've been hawkish on inflation at DoubleLine. We were not hawkish enough. We did not anticipate a 6 handle this year, even though we had one of the highest forecasts in the industry. We did not have 6. And now we actually think there is a shot at getting a 7 in the very near term. Here's another measure of inflation that tries to throw out some of the outliers, some of the tails. This is the 16% Cleveland Fed trimmed mean CPI, basically takes out the 8% lowest ones and 8% highest ones and leaves us with the other 84%. And it really is striking, isn't it? How it's just somebody rang a bell and it went straight up in just a few months from a 2% level to a 4% level. And just like I wouldn't try to be a genius and call a top on emerging markets versus the S&P to the day, I don't really think one would be wise to say that this is at a top. Here's PCE, another inflation measure, one that had been lagging others. I don't usually include this, but I just want to point out how we just saw the highest print in recent memory for the month over month at 6.3. Of course, that would annualize to about an 8% number. We also see the core index has woken up a little bit out of its slumber and went up about 0.43. So that's also rising at about 5%. Here's another inflation measure that we have talked about in the past, the PPI. It's been averaging, it's been over 0.5 every month here in 2021. So many months in a row. It's averaged by about 0.8. So we're seeing PPI. They slice and dice in a variety of ways. On this exhibit, we're using final demand, and the year over year is 8.6. There are other ways of looking at it where it's running in the double digits. And so this actually reaccelerated in the most recent month when it looked like maybe it was starting to decelerate. Here's that shelter inflation that I want to talk about again. I think this is one of the key issues. We see core services and shelter inflation. Services is 58% of CPI, and shelter is about a third of CPI. So shelter can plug a pretty big hole if it really starts to move up. We've noticed that shelter inflation has gone up as reported by the government. That's the blue line. It's gone up to 3.5, but obviously home inflation is way above 3.5%. How much above is it? Well, let's take a look. First of all, this seems to be a little bit out of order. I ordered these, so it's my fault, but this is existing home sales monthly supply, which hit an all-time low of 1.9 months back late last year, early this year. And it's still at one of the lowest levels in history at only 2.4 months. In fact, it actually dipped in the most recent month, which came a little bit as a surprise because rates were a little bit higher, maybe last-minute buyers trying to get in front of what they thought might be higher interest rates that really haven't developed very much. Now we've seen lower rates in recent period. But here's existing home sales median price year over year. And it got as high as almost 24% earlier this year, but it's still extremely elevated at 13% year over year. So we have owner's equivalent rent and the shelter component, which is a little bit broader than owner's equivalent rent, going up 3.5%. And yet existing home sale median prices are up by double digits, over 13% still, and they've been living at 13% or higher for many months now. We also have the Case-Shiller index of home prices, which is basically the highest in 20 years. It came off slightly from 20% to 19%, but this is running far, far above the so-called 3.1 owner's equivalent rent, 3.5 shelter. Here's another measure of simply rent. This is vacancies, which is the red line, and the purple line is median rent nationwide. And vacancies were running along at 6 to 7% in 2019, and the pandemic came, and we see vacancies go way down. Vacancies went from 7% down to about 4% presently. And right when they crossed over somewhere around vacancies of 5.5% or so and dipped below there, we saw the apartment list national median rent start to move higher very steadily. And now it's risen by well into the double digits, non-annualized. Just over the past 8 months or so, we have a double-digit increase in nationwide median rent. So that's going to have to filter into the shelter of the CPI. And since it's such a big component of the CPI, it's so understated versus the actual index and observed realities, it could easily add a percent to the CPI and plug a hole of something else dipping down, like some of the supply chain issues. Here's just apartment median rent. I'm just noticing the trend. There's seasonality in this thing. We brought this back to 2018, and there's this kind of year-end dip, seasonality, and there's stronger rent increases in the summer months. This time, we haven't seen the seasonality. In fact, we're seeing the trend continue. And so one should expect to see higher rents continuing through the middle of next year, even accelerating. So I did this thought experiment last webcast. I'm just repeating it. What if we used home prices as opposed to the shelter construct in the CPI? What would the CPI be? Well, it wouldn't be 6.2. It would be 12.3. Now, of course, this is simplistic and maybe hyperbolic, but it kind of shows the extent to which inflation could be stickier. And Jay Powell himself has given up on this concept of even trying to term it anything other than inflation in our time. Let's look at yield. Here we see the 12-month Treasury yield, which was completely somnolent back there post-pandemic, and now it's starting to go up. This is in anticipation of the Fed. I don't really know why we have the Fed. Why don't we just look at these charts? Because the Fed turns hawkish when the left panel starts to go up, when the market starts to anticipate higher short-term rates, one-year rates moving forward. The Fed pays attention and starts to adjust its rhetoric, which happened to a fairly large extent at the most recent meeting, where we dropped transitory and we got fairly hawkish with the doubling down on the tapering. The 2-year Treasury yield also anticipates what the Fed is doing. That started to rise way back in the first quarter of this year. It was down at 10 basis points. Now it's up in the 60s. The 2-year Treasury yield is now at the high of the year today. It's the high of the year. The 3-year Treasury yield is less than a basis point below its high of the year. So short rates are on the move. That's not going to be positive for the economy. I don't think it's enough yet to be that debilitating. But again, I think if we get these rates up above 1, I think the economy is sufficiently fragile that it might run into problems, has been the pattern for 40 years at ever lower interest rate levels as the cycles go forward. Here's the yield curve. A lot of lines on here. Let's just look at the orange line. That's the 2-year Treasury yield versus the 30-year Treasury yield. It was as high as 225 basis points earlier this year. Just about everybody and their brother was looking for a steeper yield curve. We at DoubleLine were from the outset of the pandemic into March of this year. And then we observed how offsides or one-sided positioning was on curve steepening. We turned neutral. We didn't turn into a flattener the way we probably should have, but we at least no longer looked for a steepener back in March of this year. Now we saw first a correction of the steepener, and now I think you just have to call it a flattener. We've gone from 225 basis points, 2s to 30s, and now we're down at basically 100 today, very close to 100. So it's half the way to flat from where we were in March, and the trend is definitely in place here. The bond market seems to be sussing out economic trouble. And I will once again say, as I've said, every time that the yield curve is flattened in my career, I turn on the TV and I hear people saying, it doesn't matter this time the curve is flattening, there's other factors. And one of the adjuncts to that recently, in recent cycles, has been, well, yeah, the curve's flat, but it's flat at such low rates that it doesn't really mean anything. Actually, it's the opposite. For the curve to flatten at such low rates is sending double the signal than it flattening at high rates, in my view. Because who the heck wants to buy negative real yields of 400 basis points or 600 basis points using the shadow rate for 30 years. You have to believe that there's going to be economic trouble to want to buy negative yields of that magnitude when you can buy negative yields of, perhaps, if we go inverted, of even less magnitude of negative yields by staying defensive at the short end. So we're going to be watching that. This is clearly trending in a way that is not suggesting stronger economic growth building in 2022, rather the opposite. Here is our old friend copper gold. This worked great until the pandemic. It was one of the best indicators. You notice this goes back to 2017. We use different time windows. We're choosing this 4-year or 5-year window for this exhibit. And you see the red line is the 10-year treasury yield and the blue line is the copper gold ratio. Worked really well until the Fed started manipulating interest. I said in past calls that it appeared to me the Fed was defending the 2% level on a 30-year treasury. And so I recommended in my most recent webcast or two that as unattractive as it looks fundamentally, if the 30-year treasury would get to 2%, it was something of a buy because the Fed seems to be defending it. And so we see that in the copper gold ratio, it says that the 10-year treasury should be at least 100 basis points higher than it is today. We have other metrics that we use that suggest the same types of things, but our old friend copper gold has broken down. In the last slide, this is also something of a warning sign. It's reversed in recent days, but the high yield market was starting to slump. This is the market high yield index, and we saw that it went from a price of a 110.5 down to 107.5, which is meaningful because we saw, we haven't exactly had a lot of movement to the upside in treasury rates. So this movement, it represented widening of spreads, and widening of spreads in the high yield market is always something to watch out for. Not exactly a catastrophe, retracing only a fraction of the price gain going back to the middle of 2020. But I would advise investors to keep their eyes on this high yield market because it's been reliably the canary in the coal mine for risk assets broadly. So with that, I'm going to wrap up my last webcast of the year. Thank you for your support. We're glad we've had a good year and been right on many aspects of the market. Never always right, of course, about 30% wrong. That's been about the hit rate this year. Good luck with the remainder of 2021. Enjoy the holiday season. Thank you for your support of DoubleLine, and goodbye for now.